I'm continuing now with earnings per share. This is about slide 25 in your PowerPoints, and I have added a few slides here mainly because what I would have done in class is I would have drawn things on the board. You could either go back and add a few slides to what you printed out, or you could possibly draw on the slides you've already printed out. I wouldn't recommend that you print everything out again, because all I am really adding is the representation, a visual representation of weighted average calculations. Earnings per share itself, we have basic earnings per share, which you probably had in Accounting 201. This is net incomes minus preferred dividends divided by weighted average shares outstanding. When we calculate earnings per share, we're talking about common shareholders. Therefore, if we have preferred dividends where we make a calculation, we take par times number of shares outstanding times a percentage, and we make that calculation. That's the amount that needs to be subtracted for preferred dividends. This is commonly called dividends due. Now, it doesn't mean amount that's an arrearage. It doesn't mean that it's actually been declared in a cash dividend. It means that if a dividend was declared, this is the amount we would assume the preferred dividend shareholders to get. Now, the assumption is that they may not get it this year, they may get it in another year, but we don't really care about that. We don't care. We care about the amount of net income that should be going to the preferred shareholders. So we take that percentage times par times number of shares to get that, and we did that in another chapter, so I'm not going to review that calculation. Only point I'm making here is it really doesn't matter if we pay it or we don't pay it. It's a calculation. Now, fully diluted earnings per share, you're going to take net income, but you're going to say if there's anything out there that could possibly be common shares, that could increase the number of common shares we have out there, assume as of the beginning of the year we did that. This fully diluted then may have some effects in net income. For example, if you had something which you would paid interest on, say bonds that are convertible, they don't have to be converted, they are convertible into common shares, then if that had occurred during this year, say, and again, when you calculate this, you go back to the very first of the year, say January 1st, then we wouldn't have interest expense. Therefore, our net income would go up. The other thing here is to think about if you had preferred stock that was convertible into common. And again, this fully diluted doesn't mean it has happened. In fact, it's the things that could happen. It hasn't happened. If it happened, it would go into the basic earnings per share calculations. So we have these preferred shares that are convertible into common. Well, to calculate fully diluted, then you're going to end up with more common shares outstanding, and you would not have any preferred dividends. I'm going to give you a problem that does that, and you're going to see it when we work through the exercises. So when we calculate earnings per share, you are going to calculate the weighted average number of shares based on the months, the percentage of the year in months times the number of shares outstanding, and you might have a dividend adjustment factor to calculate. And you have to calculate this for every period of time in which you're doing it. And this weighted average number of shares outstanding then is a sum coming from all kinds of adjustments. So I'm gonna work through this. You may have had this again in Accounting 201 and spent some time on it. So I'm going to use that methodology, which you probably already know. but I'm also going to use a visual representation, which I think is helpful. So here we have Sovereign Financial Corporation having net income of 154 million, and the tax rate is 40%. This is not relevant. It is not relevant at this point, the tax rate. It would be relevant if we were talking about things that were potentially diluted and effects on net income, because it's an after-tax effect on net income. So let's start January 1st when we have 60 million shares outstanding. How long are they outstanding for? The entire year. And then on March 1st, we are going to have new shares issued. If we have the new shares issued, the new shares are really going to be outstanding for us only for 10/12 of the year. We have January and we have February in which we didn't have those. So this is an incremental approach, and I think this is the approach that you understand. Now, the other approach is to look at it overall and say, what is the overall amount that is outstanding? And you'd say, well, we would have 60 million shares outstanding for 2 months, and we would have 72 million outstanding for the other 10. And that's an acceptable way to do it, but I'm going to do it consistently the way that you do it. And so a few of these slides in here will be the alternative way of doing it, but you do not need to know that. You only need to do what you have been doing. I do think, though, that the visual representation is helpful. So for basic earnings per share, you would have 60. Now they omitted the 12/12ths there, but the 60 is out for 12/12ths. And then the 12 million shares that will be there for 10/12ths of the year. So 60 times 12/12ths is 60, and 12 times 10/12ths is 10, and that's where you get the 70. Now you notice in this that they do not have any preferred stock. They have no preferred stock, so they would have no dividends that are payable to their preferred shareholders. Therefore, we don't have anything to subtract in the numerator, and that comes out to $2.20. And this is my graphical representation of the weighted average, and so I typically would go up to the marker board and I would draw this out. So I draw a box which represents a year, and then I go out and I say, okay, on March 1st, we have an increase in shares of 12. And these 12 then will be outstanding from March 1st on to the end of the year. And if I do it this way, then I find that I don't have as many errors when I start calculating how many months that 12 is out there. Because I can look at this and I can say, how many months is it from March on to the end of the year? And when you say March 1st, remember you're talking about all of March. You're not talking March 31st. So at March 1st, you have had January and February passed, so it is 10/12ths. And if I do things this way, and I think you'll see what I mean when we get into stock splits and stock dividends, that it really simplifies the problems. So I'm back to saying the same thing as we said on the previous slide, that it is 70 million. So here is that alternative way of doing it, where you say for 2/12ths of the year I had 60 out there, and then for 10/12ths I had 72. Yeah, that's another way to do it, but from my experience of talking to students, most of them, I believe, have had the previous way or previous calculation. So, if you've got your slides in front of you, you can X out this and say, I don't need it. For those of you who might have had this at another institution, I give it to you because it might be where you were. A different textbook would have done it this way. Now, here is the graphical representation of what we talk about if we have a stock dividend. And I apologize, this graphing here might be a little bit small. But we are saying that we have the same problem as we had before. We have a bump up on March 1st for those new shares that are issued. But we are going to add a little complexity to it by saying that we have a stock dividend, a 10% stock dividend. Recall that that means that everyone who owns a share of stock would get 10% of the shares that they have, uh, in addition to what they had before. So the total number of shares outstanding is going to be the previous number of shares outstanding times 1.1, because it's the same number plus 10% more. All right, that becomes important. Now I draw a line, and I draw the line down, and I use this representation to show that there's a stock split or there's a stock dividend. My line down is on June 17th. So what you see in this happening here is that after those were issued, we have another thing that would increase our number of shares outstanding. We don't worry about how many actual shares it is, because we are working on weighted average shares outstanding. And the rule here is that anything that happens after June 17th, we do not adjust, but anything that happens to the left or before June 17th, you adjust by 1.1. This is called a dividend adjustment factor. So when you have your totals, which we had previously said was 60 and 10, and if you did it this other way, you would have done it by 2/12 and 10/12. You have to have a dividend factor adjustment calculated in there. This is the one I want you to concentrate on, not this business up here. 60 times 1.1 plus 12 times 1.1 times 10/12 equals 70, and then and then you're going to add 10% more. So I believe you're going to go up again for an additional 7. So you're up to 77. And I think that's what we got up here. Now, if anything happened to the right, we wouldn't worry about it. When we get into the problems, all of this will be easier for you to understand. So if you don't quite understand what I've done here, this is the line that's relevant. The total is going to be 60 plus 10 times 1.1. So 70 times 1.1 is no longer going to be 70. It's going to be what? I believe 77. All right. Now let's continue with the problem. So this is, we had 77 there in the previous result. But now we are going to have something happening where we had, again, in January and February, we had 60, and then March on, you had another 12 coming in. But we're going to have another thing happening here, because we are going to buy back some treasury shares. So again, ignore all this. This is for those who took the class some other place. Your textbook and the way you know it is this. 60 times 1.1 plus 12, those are the new issued shares, times 10/12 times 1.1, minus the treasury shares. Now there's no 1.1 adjustment factor here. Why is there no 1.1 adjustment factor here? There's no 1.1 adjustment factor here because the treasury shares were bought after the extra 10% dividend date. Okay, when we get into the problems, I think you'll understand what we're doing there a little more. Numerator adjustments, net income should always be adjusted for dividends that we say are owed, even if the dividends are not paid. So going back to that 5 million shares, $10 par, 8%, you need to put in that adjustment as a reduction in net income, because we're talking about common shareholders and not preferred. Now let's talk about dilution and diluted earnings per share. Dilution means that the earnings per share is going to be less if the things that are out there that could be converted into shares are converted. And this is kind of like a warning to investors. We know that diluted earnings per share is not really earnings per share. It's a what if scenario. Don't ask me where this all got started. I haven't researched that, but I only know that it's been around for at least 40 years, and so we've been doing it. I don't know why it was initially started. It is a what if scenario. So if we were to have, for example, stock options, if the stock options were out there and they are exercisable, then potentially we have more common shares being outstanding. If you have common shares being outstanding, which is a number that's on the denominator, you increase a denominator, then you make the resulting ratio, which is a fraction, right? But we usually do it as in dollars and cents. If we do this number, we know that number will get smaller. So the question here is, what do you do if you have stock options? Because you also have cash coming in from the stock options. And someone, I do not know who it was, came up with this way of making the calculation and says, not only do you have more shares potentially outstanding, so it goes into the fully diluted earnings per share denominator, you will also have an adjustment because the cash could be used to buy back treasury stock. And you're assuming you're going to buy back the treasury stock at the average price for the year. So if you were to give stock options and the stock options are exercisable, you would have an increase in common shares outstanding, but you would also have a decrease because the cash you got in from those stock options would be used to buy back stock. Crazy, isn't it? So with stock options, you have cash coming in, and that is this part. And so if they were exercised, you would have additional common stock. But also, if you had this cash, which is the 300 million, you would use it to buy back treasury stock. And you know, if you have treasury stock, then the term was outstanding, which is issued minus treasury, right? So then you would be actually taking some of the shares off the market. So you have two things happening here. You have 15 million shares which are issued, and then so that would be outstanding will go up, but you also have outstanding going down because you're buying back treasury stock. And so you would have a net effect. Here it's calculated 15 issued and 12 bought back. So the net change in your weighted number of shares outstanding is only going to be 3. That's what we do. So initially when you looked at it, you'd say, oh, there's 15 more issued. You also have to take into account the cash coming in, and if you had cash coming in, you would buy back treasury shares. Don't ask me about this. This is just a convention and assumption that's made, and everyone is required to do this problem in the same way. So you really don't have to go back and redo your table because we have been working on a continuous problem. You just have to note that in the denominator, you're going to add 3 to it now. So the number where you were at 75, you'll add 3. So whenever you do the diluted earnings per share, you need to say, do I have a net income effect? Do I have a preferred dividend effect? Do those numbers change? And the net income number is after tax, by the way. And then you also are looking at your denominator and seeing what the denominator does. If you have convertible bonds, this is an interesting thing. You're going to have a numerator adjustment because net income will go up from not paying interest. This is after tax. Okay, this is after tax. And then you have a denominator effect also because you're going to have 12 million more shares outstanding. So there's with this one, the denominator is definitely going up. It's not going down in any way. And the interest is on the top. Is it dilutive or is it not dilutive? And we call that anti-dilutive. It depends on when you make the calculation if you come up with a smaller number for earnings per share or not. If you come up with a smaller number, you have to show it is considered to be dilutive. If you do not have a smaller number, you don't have to show it. It's considered to be anti-dilutive. We'll have a problem with that. So we add 12 to the bottom, we get 90, and you're just kind of accumulating with that. And then on the top though, you're going to do an after tax, 1 minus the tax rate when you're doing that adjustment to net income. So it's now at 168, I believe, is the numerator, revised net income minus preferred dividends. So these problems you can work through in your textbook, and some of my students do find it's very helpful to just work through the examples in the textbook. The problems will also help you. Preferred stock that is completely convertible into common stock. Well, the numerator is going to change because we subtract preferred dividends, and if you assume that all those preferred stock with the dividends usually has dividends on it, you're no longer paying it, then you would have nothing to subtract. And then the other thing is that you are going to increase the number of shares of common. And again, all these potentially dilution issues, the diluted earnings per share calculations, need to be as of the beginning of the year. So you don't really have to go back and say for how many months of the year or anything. You're just going to say, I'm going to assume it started at January 1st. And we had done these things January 1st. Okay, that the preferred shareholders had decided to convert January 1st, or that the options that were held were exercised January 1st. So all of the assumptions date back to the very beginning, so there's no percentage of the year that you have to do in the calculation. If they are anti-diluted, that is, the number of shares does not increase as a result of that, or when we do our calculation, we find that the basic earnings per share is still less than fully diluted. If this happens, we are going to ignore anything that would go into the calculation that would do that. And the other thing is, if you do your calculations, you're supposed to be doing those in the order that it would have the greatest impact or the greatest reduction in earnings per share. So you include those that have the greatest effect first, and you incrementally go through until you get to a point where you don't have any reduction from the potential factors that might reduce earnings per share. And that's what you do if you have a multitude of things that could be potentially converted into common shares. So I tend to not give very difficult problems in this area, but to cover just the basics and not to give you an expanded problem. In your homework, there is an example with a solution that gives you the full thing of many different factors that can affect dilution, and it talks about those and it shows how you handle all those. It might be an interesting exercise for you to read through it, because in reading through it you would understand what we're making in our points on this slide. However, again, I'm not going to ask you to make all those complicated calculations. It takes some time to really work through a problem like that, because you do have to figure out which has the greater effect and to include those with the greatest effect first. Then go back and calculate everything and then do an incremental approach. It just takes some time. Now, for our financial statement, when we do earnings per share, the net income number in our calculation, the numerator, remember it's net income minus preferred dividends, and on the denominator, you're using weighted average shares. when you do that calculation, instead of net income, you also need to do it, should say in addition to net income, you need to put in there income from continuing operations minus preferred dividends. And then you also need to do discontinued operations minus preferred dividends for numerators. So you have three numerators, right? And then you have your weighted average number of shares outstanding, which is your basic number. Now, the second thing is if you have anything at all that has potential dilution, you need to calculate each one of these for the fully diluted earnings per share. If fully diluted is not less than basic, then you do not have to get into it. However, if fully diluted is going to be less, then you're actually going to be showing 6 things, right? You're going to be showing your basic earnings per share, where the numerator instead of net income includes either income from continuing operations or discontinued operations, and then also net income, as we did it in class, net income minus preferred dividends. And then you're going to have to do the calculations also based on the fully diluted amounts. That means that the income from continuing operations minus preferred dividends might have changed for some adjustment factors, as might have discontinued operations minus preferred dividends, as might net income minus preferred dividends. These may have been adjusted. The numerator might have been adjusted. The denominator should, I think in most instances, would have been adjusted. So there's a potential here for having to report 6 earnings per share numbers on the face of the financial statements. Okay,